In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels. And yes, it is afternoon. It's 4 p.m., but it's Wednesday afternoon. So we are once again recording early today. This will be aired 4 p.m. on Thursday. So now we know Google's earnings, and I think they just dropped out, didn't they, Stu? What are they?
They did. The numbers kind of look pretty good. It was up 5 initially, and now it seems to be down 5. So
No way, just in a matter of seconds.
And it's funny, like the implied range was $10, and here we have our $10. And
there you go. It's amazing how the market can get that.
How the market can do that, isn't it?
Pretty accurate. Yeah. Well, speaking of kind of oddities and bizarre things and mysteries, we have another one for everyone today. This is a common question that we get with traders. If you are new to covered calls or maybe been doing them for a while, you might have noticed this and kind of scratching your head going, what happened to my money? I don't understand. And it's a very common question. So let's start off with our Chalk Talk question. So here we go, Stu. You got 100 shares of $100 stock, so it's a $10,000 value. We're going to assume that that's the only thing in the account just to make the accounting easy.
Yeah.
All right, so you look at your account, it says it's worth 10 grand.
Yeah.
You click on a button to sell a call. You sell an at the money $100 call for $5, which is really $500.
Yeah.
The question is, what's the value of your account now? So it seems like a straightforward question, but here are the answers. 10,000, more than 10,000, or possibly less than 10,000. How is that possible? Well, we're going to find out. I want everybody out there to kind of think what you would think the answer would be. And I guess we could probably nudge everybody in that direction. Everybody is going to guess that it's more than 10,000 and should be 10,500. After all, it was worth 10K. We just pocketed 500. But is that really how it works?
No, can I request a check for 500 from the clearing agent?
Do what?
Can I request a check, please, from the clearing?
Exactly. Yeah, people think, oh, I'll click that button and I'll just get a check for $500. Not the way that it works. Yep, and we're going to find out why. So we have a little mystery on our hands here, Stu. A covered call mystery. We're going to figure out why this accounting seems so weird and like why somebody seems to be reaching in and stealing your cash.
And what's the big picture here, everyone? It's not free money.
It's not free money, and you're going to find out why. But it's also to show the accounting of it, which really seems bizarre. If you only know the covered call on a surface level, push button, get cash, you would think that it's going to instantly jump plus 500 in that example. But you do that in the real world, you'll see that's not true. So that's the mystery. Why is that what's happening? So that's our question for today. Before we get started, please remember marketrebellion.com/get started. Lots of great articles, videos, topics just like this to help you understand options and make better decisions. So let's do a quick overview here, Stu, of the covered call. This is a strategy where you're going to buy shares of stock, or perhaps you already own them, and you're going to sell calls in a 1-to-1 ratio. So what this means is that each option contract controls, assuming it's not an adjusted option, but controls 100 shares of stock. So you would have to have 100 shares of stock. That's what it means to be in a 1-to-1 ratio. So for instance, maybe you buy 100 shares and you sell one call, or you buy 300 shares and sell 3 calls. That would be in a 1-to-1 ratio. Now, a little side note, you're not required to sell against the entire position. So if you had 300 shares, you could maybe sell 1 call, 2, or 3. You just couldn't sell more than that without having a naked position on there. So that's the setup for the strategy. Now, when we sell the call, one of the motivating factors is that we do receive cash. However, what's the trade-off here? We have the obligation to sell shares for the strike. Now, a lot of times when people do this, what's a mistake that everybody does here, Stu? They'll say, well, I bought the stock, or the stock's currently at 100 and I sold maybe the 105 call. So I'm getting paid to sell at a favorable price. Another misconception.
Yeah.
You're not getting paid to sell at a favorable price, because the only time you're going to get assigned or called out is if the stock is above that strike. And if it's above, it's no longer a favorable price. So part of making the covered call successful is to have the proper mindset and to realize you're getting paid to sell at a possibly disadvantageous price, but in the meantime, you're holding all of the downside risk. So that's the strategy in a nutshell. So let's look at an example. Stock's at 100, you buy 100 shares, or again, maybe you've already had them in your account, and you sell the at-the-money $100 call for 5. Now, because it's at the money, we have no possibilities for capital gains. What's our maximum gain here? 500 bucks. No matter how high that stock price goes, most you can make is $5. What's our break even? 95.
And
So
where's that coming from, everyone? Just follow the money here. Look, you took in $5. Well,
Took in $5.
down 5, you got $5 in your pocket, then you can allocate towards that loss, and that's why we call it a break even.
Correct. So had you not sold the call and the stock falls 5% from 100 to 95, you'd be down 5%.
You would. You'd be down
Which is a pretty good hit.
Yeah, it is.
But if you sold the call, you're just at break even.
Yep.
So it's a downside hedge. That's the primary reason for using the covered call, even though most traders will tell you it's about generating cash and creating superior returns, which
Do
is
they call that a
definitely not
hedge,
true. It's
Bill?
about the downside hedge.
In some parlor or in the back room somewhere, do they call that a hedge?
Yeah, exactly. Now, what's our maximum loss? Also the same as the break even. Now, yes, it's extreme, but if you're going to ask for the maximum, that's it. So we effectively, remember, we had stock worth 100. Doesn't matter what you paid for it. It was worth 100 when we sold the call. So that's how we should see our risk. We collected 5. So we got $95 into it. What's the worst that can happen? Goes to 0, in which case we're out 95.
So we kind of saw some stock go to 0 last week.
Yeah, PHH, unbelievable. Went from, what, 45 or something down to below $1 within a couple of days.
Oh, here's a quick observation. I'm looking at this slide, and I see that my max gain on this strategy is $5. And I also see that if the you know what hits the fan in a big way, I'm down 95. Yet I hear till no end that this is an income, and I have that in quotes, income producing strategy. So think about this, people. How can this be an income producing strategy if I can actually lose $95?
Yeah.
Or some piece of 95. Like, don't you think there's a piece of risk in here somewhere?
That's right.
Right? You're not like, hey, show up, mow lawn, get paid $100. You know, it's not like that.
No. You're putting money at risk. And remember, it doesn't matter how much you paid for. You could have a $10 cost basis on this stock. If it's trading for 100 right now, from a risk management perspective, we should see that the risk, the amount we're risking, is 100. Why? All you have to do is push the sell button, and now you've got $100 cash. And so by choosing to not hit the sell button, you're saying, I'm willing to commit $100 worth of value to this strategy, and that's really what's at risk. So
Which,
that's
by the
all.
way,
That
everyone,
also catches a lot of people by surprise who've been in the stock for a long time and maybe been selling calls against it, and they've got a very low cost basis. Don't let that fool you.
that's right. I was just going to say that. You might have a cost basis of $5 or
Or
$10.
-5. All right, you've
Negative
written
five even, yeah. But it's $100 today, and you
correct.
hit button, get $100. That stock it's a commodity, just like cash is a commodity, and you can actually flip back and forth, sell it, get cash, buy it, now you own stock, sell it, it's the same thing, right? It just has a value, and it looks a little bit different, but in the reality, it's just the stock is representing an amount of cash that is completely dynamic and variable. I mean, it changes all the time, right? It goes up, it goes down. It's
And you're
your
holding that.
your investment is that you think it will be worth more in the future. You're betting on the company, or you're betting on the market if it's a major market index. But it is very, very dynamic. And on these covered calls, you do have risk to the downside.
Yep.
So don't think that this is push button free. Get free money. It's not.
Yeah. So
It's not.
now for this particular setup that we have right here, this is our risk graph. So we sold the 100 call. We get our bend right there at 100, and we can see the maximum gain, the highest peak of that blue curve is right there at 5. So that's the best we can do because we sold an at the money call. Now, another problem that some traders run into is they'll say, well, why would I want to completely seal off all gains above the current stock price? Why wouldn't I sell the 105 or the 110 where I could get some capital gains? And that's a good question. And the reason is that as you sell higher strike calls for the same expiration, they're going to get cheaper.
Get less money.
So you're going to get a bigger downside hedge for selling the at the money. But if you sell the 110, you might only get $1. So
Uh-huh.
you're not going to get the downside hedge, but you could get a far bigger capital gain.
Now, Bill, if I want to sell the stock at 110, should I just go ahead and sell the 110s?
Well, that's another good question because if you're going to sell let's say a call as an extreme example, maybe you sell the 120 call for 20 cents.
Yeah.
You put 20 bucks in your pocket and people say, "Oh, if I get called out, I made over 20% of my money. Covered call is wonderful." No, you didn't. That
No,
was
you
the
didn't.
stock.
You made it all from the
You
stock.
made it all minus 20 cents, but you basically made it all from the stock. You would have made that same return had options not even existed. That's not part of the option strategy. In that
So what's the moral
example,
of that story? Don't sell a call at a strike
for
thinking that
peanuts,
for peanuts, thinking that you're creating some sort of predetermined sale in the stock.
right?
Right? It
You're
doesn't.
holding all of this downside risk in exchange for this premium. So it's a balancing act. Now, we've even done for our ICF instant cash flow service, sometimes on the more volatile issues, we'll sell an in the money option. We might sell a 95 call, get $5 of intrinsic value plus maybe another $3 or $4 of extrinsic,
Yeah.
give ourselves a much better downside hedge. So those
It's
are just some of the things you have to consider when you're doing
and
the
that's a
covered
great
call.
strategy. And think about this, everyone. Think about that $3 of extrinsic value. You can get $3 of extrinsic value in the money, and you can get $3 of extrinsic
Two
value,
different ways, correct?
right? If you sell them in the money, you got the additional whatever, five, I guess, if you're talking about the 95s of downside protection.
Correct.
Um, if you, and you'll have, if you sell the 105s, then you have that upside capital appreciation, which
Right.
you benefit from. So, there's a balancing act in there,
Yeah, they all have their pros and cons.
but
Yep.
that extrinsic value is for sure going to zero at some
That's right.
point.
And that's part of our mystery that we're going to solve here. So let's look at an example. We're going to use the same example, but again, to make things easier, we're going to assume that nothing else is in the account. It's just to make the math easier. So you've got an account worth 10,000 bucks. You buy 100 shares at 100 bucks per share. So now we've just transferred the cash into stock. but your account value still shows 10,000. You sell the $100 call for 5, which remember that's really 500 because each contract controls 100 shares. So you would expect that your account right now, the second you press button and say sell that call, should be worth 10,500. It makes perfect sense. I just collected 500 bucks. But what if it were still 10,000 or worse yet, 9,990? It's like you lost $10. And people are going, where's my money? So anybody who has ever sold a call, now they might not notice it if they've got a big account because there's just so much money and another stock could tick up and they go, oh yeah, there's my 500 bucks. But that's why we want to do it on a very small scale to show you it's not going to be there. At least not yet.
Not yet. When will it be there? I guess we're going to get there, right?
We're going to get there, exactly. But this is the setup where so many people go, I don't understand the covered call. So if you've ever bumped into this and said, where's my money? Here's where it is. So let's say that we started off our account with $10,000 cash. So here's our broker platform, and it says the amount of cash you have is 10K. Positions, we have no positions. And we look at the total account value, and our broker says it's 10,000, which is all cash. But now we buy 100 shares of $100 stock. What happens now? We have 100 shares of ABC worth 10,000. What's our cash worth over here? 0. We just swapped out the cash for the shares, but the total account value is still 10,000. It's not sitting in cash, it's sitting in stock.
Yep.
Okay, so far so good. Now we turn around, we push button, we get cash.
100, everyone, right? Remember, it's assuming that the stock is still 100. Nothing else changed.
Yep. So we push button, we get cash, and it says there's 500 cash. And actually, if you go to your money market, you will see $500 cash sitting there.
Yep.
But they don't see it in the overall portfolio.
Mhm.
And that's the mystery. And here's what happens. Your position, remember, was 100 shares of ABC, still worth 10,000. That's assuming the stock hasn't moved. However, you're going to have a new position down here. What is it? You have a short ABC $100 call. That's what that -1 is. It means you have sold something that is not in the account, right? I didn't see a $100 call in here to sell. It's selling to open. And so the broker says, well, all right, look, Mr. Trader here, you cannot just close down the account and walk away with 500 bucks. You've got a little liability over here right now that is equal to the cash. So this $500 cash in your money market is exactly offsetting the $500 liability that's in your positions. So what's your account worth right now? 10,000 bucks. It hasn't moved. And again, this is where people are only looking at half the puzzle. They say, I should have 500 cash. And if they look in the money market, they'll see it, but they're forgetting that they have a new position. That's a short position, that's a liability. And this minus sign means that if you wanted to get out of this call now, you would have to spend $500 to close it. Then if you wanted to walk away or close the account, you could. But you've got to settle this liability first. That's the mystery. So let's see how we end up making the money. Before we do, quick reminder, everyone, marketrebellion.com/get started, where we have lots of information just like this, different strategies and all the weird things that can happen with options. We tell traders they're multifaceted. It's not like trading stock where it's just up or down. So if you're new to options, definitely check this out and make sure you get a good foundation before you start trading. But now let's step into the truly bizarre, Stu. Let's say that the second that we sell this call, the bid was 5, which is typically where we're going to sell, right? These are buyers. These are sellers. So when we clicked on sell, we get matched with a buyer. And so in my example, that's why we got $5. But if you wanted to close this, what's the asking price? $5.10. So what some brokers will do is they'll say, look, I don't care what price you got for it when you sold it. What I'm worried about is what's it going to cost you to close it right now? What we call marking to market. Now, again, what do you want to call market? Is it the bid? Is it the midpoint? Is it the asking price? Good questions, but a lot of brokers are going to say, well, if you sold the call, which is what you've got over here, it's sold, we should mark it to the current asking price. So some brokers are going to say, yes, you got 500 bucks from the sale of that call, but your liability is 510 because that's the asking price. So what's the value of the account now? $99.90. Talk about weird. So you can see where people get all kinds of confused. I got 10,000, I can see it. I push button, I got 500, and now my broker's telling me that I've lost $10. Must be the market makers, right? But this is why. This is the big mystery, is that you have a corresponding liability, and depending on how you want to value that liability. Now, of course, if the stock starts going up, this number is going to go up, and your account could start going down because that liability has not been settled yet. So now let's see what would happen before we actually start seeing cash. What's got to happen? Well, again, this doesn't go away. It's cash. It's always worth 500. But let's say that some time goes by, the option decays away a little bit. We still have -1, and the broker says, well, the asking price right now is $4. So if you wanted to exit the position now, it's going to be 400 bucks. So what's the accounting now? Plus 500 minus 400 is a net what? 100 bucks. Now your account's going to show 10,100. But you can see that might take some time. Now it could also be that the call value went down because the stock went down, but then that means that this number goes down too. So that's why we're holding this constant throughout, just to show you what's required to get this to show up as 10,500. So now let's say some more time goes by. Cash is worth cash. The stock we're assuming is the same. And let's say that, again, time has gone by, theta's kicked in, and this $100 call is now worth $2, or -2 to you. You would have to spend $2 to close it out. What's our position worth now? 10,300.
Look at what's going on here, people. What Bill's, that bottom number, that total account value, what he's referring to is what you see on your platform as your net liquidating balance, or your
Correct.
net, as we say in a business. And behind the scenes, what you don't see, which Bill is kind of showing you here, is there's another category of money that the brokers are never really going to talk to you about, because they don't want to, because they make money on it, because they're really a bank. But that's a whole nother story. So, there's money coming in and there's money going out, and they charge you different amounts of interest based on either of them. But that is different than your net lick.
Right.
See, what Bill is doing here is he is accounting for the value of the call and how your net lick changes.
Yeah.
How you can realize the money.
Correct. That's
Yeah.
the term they would use in accounting, that we have realized the money. We've now kind of earned it. You might think of this as, for all of the accounting people out there, as unearned revenue. It's there, but we haven't really earned it because we haven't settled our liability yet.
Right.
So now let's take another step. Let's say more time goes by, and now the account, the stock stays at 100. So that position is worth 10,000, but the call expires worthless. And so the broker sees that the value of the call is 0. And what are they going to show the value of your account is now? Now it will show 10,500.
Right. And you can play all kinds of games with this. If the stock was like 5, you're going to make 500 bucks on the stock, and the calls would be 5, and you're going to make nothing on a call.
That's right.
It's the whole, caboodle here. You got to look at both of them. It's not, oh, I made money on the stock and I lost money on the call, I should have never sold the call. It's a unit, right? This covered call is a strategy.
Right.
It is two pieces of the puzzle, and the puzzle has, it's one puzzle that has two pieces in it. So, and it has a delta, and you shave off part of the upside in return for getting paid up front, which you can't really use until you actually realize the money.
Yep. So that's really the big key, is to recognize that when you push button and get cash, the reason you got the cash is because you accepted a liability.
Very
And we
important.
have to account for that liability. And
Mhm.
only when that liability, if that liability goes to zero, then you realize the full cash. Now, of course, we have another balancing act. That's assuming the stock stays here,
Yeah, of
which is
course.
why it's wrong when people go, "Oh, I want the stock to go down because then I can collect the full value from the
Yeah,
call."
that is so
You let that
stupid.
stock go down to 70, and you're going to see why that's
That
very wrong.
is ridiculous.
No, you
Yeah,
want the stock to stay still or go up. Covered call is neutral to slightly bullish.
the bullish. Yeah.
It's not a bearish strategy.
Oh, I want
Selling
the
a
stock
call
to
by
go down so
itself
I can
is
buy my
bearish.
call back. Really? I mean, you're just saying I want to lose money.
Yeah. Selling a call by itself is bearish, but as soon as you add another asset, in this case stock, completely changes the picture. You need to be aware of that.
See, the
So the
call
main thing,
delta is going to be lower than the stock, right? We're talking about 1-to-1
yeah,
here. So you're going to have a long delta position.
yes,
Why
you
would you
will.
want the stock to go down if you have a long delta position?
Nope, correct. So the main thing to see is that the only way you're going to realize the full value, in this case of the 500 bucks, is when the option expires, which means if this were a 30-day option, your account's not going to show that for 30 days. So don't think that you're going to push the button, sell that call for 500 and it appears in your account. It does show up in your money market. That is true, but you're forgetting that you've got a corresponding liability that has to be accounted for over here.
Yeah, and just a quick note on that mark to market. Some of the platforms out there do mark a long position to the bid and a
Right?
short position to the offer. One of which I know for a fact is Fidelity, unless they've changed it in the past year or so. But the vast majority of them actually do mark to market in the middle of the quote.
Correct.
Whatever the bid and the ask is, whatever that middle is how they kind of mark to market. And that mark to market relative to your purchase or sale price is what's generating the P&L.
That's right.
Along with the stock, wherever you purchased it or sold it short, relative to the mark to market, the current price is generating the P&L. And together they generate a net liquidating value or a net
That's right.
P&L.
Yep. Yep. So anyway, we wanted to pass that along because we were talking about similar topics in our Q&A classes, and we know there's a lot of people who have questions about this mystery here of the covered call. They'll say, well, I pushed button, I should have gotten cash, and it didn't show up. And they don't realize it did show up. They're just forgetting that you have to account for the liability too. That liability has to be settled either by buying it back.
Yeah, you can buy it back. That's right. You can
So
buy it
the
back.
second you sold it, if it were still marked to market at 5, you sold it for 5, you buy it back. Well, now you're still back to 10,000. You don't have anything to show for it. You've got to let that liability go to zero before you're going to realize the full cash value. That's the mystery, the big secret that everybody wonders about with the covered call. So we hope that helps all of you out there. And Stu, let's go ahead and answer our covered call. Oh, I'm sorry, we still got a little summary here. My mistake. So the covered call, you do receive immediate cash. That is true. But you also receive an attached liability. That's the part that people forget. So as we mentioned in the accounting world, they call that unearned revenue. Yes, we took in the amount, but we shouldn't really start spending it until we've earned it, right? In this case, we have to let time go by. So you don't earn or realize that value until expiration. That's
I
assuming
just
that you
thought of
ride it
something.
all the way to expiration.
How many of us out there, and I'm guilty, have spent unearned revenue?
No, businesses do it all the time.
And if it doesn't come in, it's a problem, right? So it's,
That's why in the accounting world they do that. They say you shouldn't start taking this until it's been earned. Right. So anyway, again, we hope that helps. So let's go back down to our chalk talk, and hopefully you can answer the question now. You have 100 shares of $100 stock, 10 grand, check. You sell a $100 call for 5 or 500 bucks. What's the account worth now? So the answers that we gave at the beginning, 10,000, more than 10,000, possibly less than 10,000. So the answers here are really two of them, either A or C. But it's not more than 10,000. You're not going to see that until expiration.
Till the five, well, till the five goes to four, and
Yep.
then maybe the stock goes to 102 or something like that, or the stock
And
goes
assuming that the stock, right, exactly, the stock's got to stay the same. It's a balancing act.
yeah, maybe the stock goes down two and the call goes down three, and you're actually up $1. Your
Could
net
be.
lick is gonna show up $1. They're a unit here, so
That's right.
treat them that way.
Yeah. So anyway, we hope that that helps. We'll have to see how Google fares tomorrow, but we'll see most of you live from our Q&A classes tomorrow at 4 p.m. on Thursday, and we'll also see you at noon for Q&A part 2. And for everybody out there in YouTube land, we hope that this really helps you to solve the mystery of the missing cash when it comes to covered calls. And we'll see you
Where's the
next
money?
week on Coach's Corner.
See ya.